Welcome to Module 29 of Counting 5,000. In Module 29, we're going to continue our discussion of Chapter 15. We're going to do the middle part of the chapter. Remember, as I said previously, we had done the beginning and the end. Well, now we're going to pick up the middle. And what we're going to look at here is look at the budgeting problems per unit on the three variable costs, direct labor, direct materials, and variable overhead, and a little bit on the fixed overhead. And we're going to look at how we can see where our problems lie. So what we're going to do in here is analyze all our differences between what we had planned and what actually happened. Remember, the difference is called a variance. And we're looking at a budget and actuals and seeing what the differences are. Now, there are two reasons why there can be a difference. It could be based on the amount of input or the cost of the input. So when we compare the budget to the actual, we may actually break down that particular difference into two parts. So what we're going to have to do is look at these differences, what we call variances, and say, why do these happen? In order to figure out why, we have to know who was responsible for that particular area of activity. For example, in raw materials, we're going to look at how much input we had, how many raw materials we used, and what the cost of those raw materials were. And we're going to compare that to our budgeted amount of projected cost and projected quantity. Now, different people are related to the two different activities. The purchasing department is responsible for purchasing the raw materials, and the production is responsible for using the raw materials. So the person responsible for the cost component may be different from the person responsible for the usage component. So we need to know who's responsible for each part. So we take it and break it down into a usage and a cost difference, and we give those to different managers so that they can explain why those differences occurred. Typically, we call them usage variances and efficiency variances. Those are quantity variances. We also look at the cost side, and they may be called rate variances, price variances, or spending variances, and the differences depend on which type of variance we're looking at, whether it's materials, labor, or overhead. I will tend to call them quantity variances and price variances just as a generic term so that you can understand what we're doing. And there's a very great similarity between all the things we're going to be looking at in materials, labor, and variable overhead, so that if I use a generic term, it may be easier for you to understand the process that we're looking at. For example, let's look at direct labor. That's probably the easiest one to understand. You have people making the product, and you have a cost for those people making the product. How long it takes them to make the product and what it costs per hour for them to make the product. So that's an efficiency variance and a cost variance. So there's a price variance and a quantity variance. The quantity of hours and the price per hour. So we want to break that up. We want to look at those two different variances for direct labor. And as I said, they have different names. For example, on direct labor, the second line there, an efficiency variance and a rate variance. I will tend to call them quantity variance and cost variance, just because the technical names you can come up with as you work with it. For example, the raw materials usage variance and raw material price variance. But for our purposes today, we're just going to try to understand the theory behind it and how it works. We're not going to actually get into the technical side. But if you can understand the idea of quantity variance and price variance, you'll understand the problems that are involved in coming up with these variances. So typically there are two ways you can look at these variances. One of them is called a mathematical approach, which is the one that's in front of you there, where you can figure a quantity variance and a price variance. You simply take the standard quantity minus the actual quantity and multiply it by a standard cost. Or for the input variance, you can take the standard quantity minus the actual quantity times the standard price. That's the typical way you look at an algebraic approach to figuring out the two different kinds of variances. My preference is to look at what's called the graphical approach. In the graphical approach, you draw out three different types of variances. For example, in the first or left side, you take the actual quantity times the actual cost. In the middle, you take the actual quantity times the standard cost. And on the far right, you take the standard cost times the standard quantity. Now, if you'll notice, the reason I like this particular approach is that the first side, the actual times the actual, totals up to your actual cost. The extreme right side, where you have standard times standard, is your budget. So when you get the total of the two pieces, you have your total difference, your total variance. All you're doing in the middle there, by comparing the actual cost times actual quantity, the actual quantity times standard cost, is finding out the cost variance. And then the quantity variance is simply the second piece, where you compare actual standard and standard standard. So I really like this approach, and you'll see that I use it a lot when I'm looking at variances. You can use the mathematical approach, which we talked about previously, or this one. It doesn't matter. Your answers will be the same. If you understand one, you'll probably understand the other, although often it's easier to understand the graphical approach first and then move on to the algebraic approach. It just depends on which approach you like better for yourself. Remember, all we're looking at is trying to find the differences between actual and budgeted. And we want to break those differences down so that we can get an explanation from the particular individual who's responsible for that difference. So we're just looking at the different variances, a price variance and a quantity variance. We can do the same thing for raw materials, but raw materials have a different kink in them. Let's talk just a second about raw materials. Firms purchase materials often in larger quantities than they use raw materials. So they will have two different types of variances for the raw materials. They will take the standard cost and the actual cost of what they purchased, and then you'll take the actual cost of what they used times the actual quantity they used. So you'll break this one down a little bit differently. We have a problem like that we're going to work in a few minutes. Be aware that raw materials is a little bit different from the other two, from direct labor and the variable overhead, simply because we often purchase more than we use. If we use and purchase the same thing, it doesn't matter. We can do it exactly like we do the labor and the variable overhead. If it's different, we have to do a little bit different step, but it still gives us the actual results that we want. The one thing that is different is fixed overhead. Remember, we said we couldn't put fixed overhead on a per unit basis. So what we do with fixed overhead is we come up with three total amounts. We come up with our budgeted fixed overhead, our actual fixed overhead, and then in the middle piece, remember our graphical, we always had three pieces. The middle piece then is our applied overhead. So it's a little bit different. It still has the same three components, but we do it on a total amount rather than a per unit amount. The other three, direct materials, direct labor, and variable overhead, are done on a per unit basis, on a cost per unit. Fixed is done as a total because we can't unitize it. So the variances are a little different because we're looking at the difference between applied and actual and applied and budgeted, but it's not a significant difference except that we're using totals. What do we do with any overhead variances that we have left over? Typically the variances will be fairly small. Companies get very good at projecting what their costs are going to be, in other words their budget, and they get pretty good at controlling their costs, so they get the actuals very close to their budget. So typically the difference will be very small or insignificant, in which case we just take the difference and put it in cost of goods sold and flip it out into the income statement. However, if it's a real big difference, if the variance is pretty large, then what we have to do is take that variance and divide it up on a prorated basis between cost of goods sold and inventory. If it's a huge difference and most of our products went to cost of goods sold, then we put most of the variance in cost of goods sold and a little bit of the variance in inventory. However, like I said, most companies keep it pretty insignificant. It's usually not a major amount of money, so we don't have to worry about allocating it. But if you do, if you have a large amount to allocate, divide it up in relation to how much of your inventory went into cost of goods sold, how much of your production went into inventory. Well, let's practice a little bit. Let's do problem 13, middle of page 560, and let's look at how we do these variances. This may help explain some of the problems that you're thinking about occurring. For example, in problem 13 it says that they give you the standard for one case of spring fever tonic, the direct materials, direct labor, variable overhead per each of those per the product. Then they tell you that during the week of April 25th they had these following activities that took place. Notice the first and the third. 7,400 pounds of raw materials were purchased at $4.95 a pound, and then in the third one $8,300 were used. So we have a difference between the amount we purchased and the amount we used. So some of it is staying in inventory. So we're going to have to do a little bit different approach on our analysis. We still do the same thing. Let's do the purchasing variance first, as if we were purchasing it. Let's take the 7,400 units that we actually purchased and multiply that by the actual price we paid, which was $4.95. And let's compare that to the actual amount we purchased and what we should have paid, which was $5. If you do your math there, you find out that the difference between the actual quantity times actual price and the actual quantity times standard price is $370 to the good. That's a favorable variance. That means that your purchasing department did a good job. They were able to purchase the raw materials for less than they had budgeted. Now we're going to have to change a little bit to look at the differences for the production, because we're going to use the actual used amount of raw materials rather than the raw materials purchased. So in the second part, what we're going to do, our actual quantity will be what we used, which was the 8,300 units times $5, standard price. And to find out the standard quantity we should have used, we have to refer back to the purple material and know that it takes 4 pounds for each unit that we're making. And we're making 2,000 cases. So we should have used 8,000 pounds of this stuff at $5 a piece. So we actually used less. Actually, we used more, didn't we? We actually used more than our standard. Our standard was 8,000. We actually used 8,300. So our difference was $1,500 of unfavorable variance, which means that we used more raw materials. Now, as a manager, you would ask yourself, okay, why would that happen? Why could you have a favorable variance in the purchasing side, unfavorable in the usage side? Well, perhaps one of the reasons they got a favorable variance in the purchase side was that they bought inferior raw materials, not quite as good a quality as they were used to buying. Then when they went to use it on the production floor, the materials were so inferior that they had to use more of them. So it took more usage, therefore they had an unfavorable variance in usage, whereas the purchasing department had a favorable variance in the purchase. So there has to be a trade-off there, and management would want to know those two items. They may not be related, but then again, they may be related. Let's do the same thing for our direct labor. Remember, we're going to take our actual quantity times our actual price of direct labor. We actually used 5,800 direct labor hours. They don't tell us how much it costs, but they give us the total there of $78,300, so I just figured out it was $13.50 an hour. Our actual quantity, again, was 5,800 hours, and our price per hour should have been $13. So our standard there, we're comparing our actual $78,300 to $75,400, so we had a $2,900 unfavorable variance, simply based on what we had to pay our workers. So we had to pay them more. Let's hope they did a better job. Let's look at the next variance for direct labor, where we take our actual quantity times our standard price, which would be 5,800 times $13. And again, we have to figure out our standard quantity. In the purple box, it tells us it takes 3 hours for each of the cases, and we made 2,000 cases. So that should be 6,000. 6,000 times $13 would be $78,000. So our difference there is a $2,600 favorable variance. So they were better. They were more efficient. This is a quantity variance. They were better at doing their job. So perhaps we had to pay more to get more skilled labor. So that may be why our price was unfavorable, but our efficiency or quantity was favorable. We had to pay more, but they did a better job. So that's kind of the way you look at the analysis. The next one they want us to look at are the variable overhead variances. Again, these are very similar to the direct materials and direct labor. You simply take the actual quantity times the actual price. Direct variable overhead is based on direct labor hours. So you take the same number of hours you had for direct labor, which is 5,800. You multiply by that by the $6.15 to get 35,670. They actually gave you 35,670. I just figured the 615 myself just to fill out the holes in the formula. Then you take the 5,800 your actual quantity times your standard price of $6, you get $34,800. So they had an unfavorable variance here of $870. In other words, they spent more, 15 cents more per hour, and it added up to $870 unfavorable. Let's look at the quantity variance. Now, it should be related again to our direct materials, or excuse me, our direct labor, because it's based on the same thing. So we take our actual quantity of hours of 5,800 times our standard price of $6 times what it should have taken us. Now again, remember it takes 3 hours times our 2,000 cases we're making, that's 6,000. At $6 each, that's $36,000. So we have a $1,200 favorable variance here. In other words, we were very efficient. We were able to use our equipment or whatever we were doing in our variable overhead much more efficiently. Although it cost us more, we were able to use it efficiently. So in that problem, what we have done is to look at those 6 types of variances. 2 for materials, 2 for labor, 2 for variable overhead. In your syllabus, it has also problem 14 listed. I wanted to put this one in so that you could practice working a problem. It's very similar to problem 13. It's set up almost identically, so you should be able to work it without too much problem. Just in case you run into some hurdles that you can't quite master, or if you want to check your answers, problem 14 solution is presented in your slides so you can check yourself as you go through. To do one more, let's look at problem 17 in your textbook, which is looking at the fixed overhead variances. Problem 17 is in the middle of page 562. You've got a company that's given you a production budget which is making 40,000 units of a single product. It allows a half of a machine hour for every unit they produce. The fixed overhead budget was $36,000. They use an absorption costing system, which means they include all costs. Actual activity and costs were, the units produced were 39,000 and the fixed overhead costs incurred were 37,000. So they ask you in Part A to calculate the predetermined fixed overhead application rate that would be used. Now you've done this before in a previous chapter. In this case, you take your estimated overhead, which is $36,000, and you divide it by your estimated activity, which is based on the number of units they're going to make, which is 40,000 units that take a half an hour each of machine hours. So it's going to actually take them 20,000 machine hours. You divide that into the 36,000 estimated overhead, and you get $1.80 per machine hour. That's how you're going to apply your overhead. Then in Part B, they ask you to calculate the number of machine hours that would be allowed for actual October production. Well, you figure out how many machine hours that would be. You made 39,000 units. Each one of them takes a half an hour. So that's 19,500 machine hours. Then in Part C, they ask you to calculate the fixed overhead applied to work in process. Again, you take that 39,000 times a half, which is 19,500, times your $1.80. That'll give you $35,100. Finally, in D, they actually get you to figure the variances. Calculate the over or under applied fixed overhead for October. Okay, their actual was 37,000. They applied 35,100. So they had $1,900 of under applied overhead. They didn't apply enough overhead. The reason for that is they produced only 39,000 when they were supposed to produce 40. Finally, they want you to compare the actual overhead to the budgeted overhead. Now remember, they budgeted their overhead at 36,000. Their actual overhead was 37,000. So they spent $1,000 more in overhead than they had budgeted. So if you want to combine both of the variances, the budgeted overhead and the applied overhead, you get a $900 unfavorable variance for your overhead. So those two problems, problem 13 and problem 17 combined, give you an overview of how to do variances for your variable costs, including direct materials, direct labor, and variable overhead. And then problem 17 gave you a way to look at fixed overhead variances, looking at budgeted overhead, actual overhead, and applied overhead. Again, you'll probably want to take some time and work through problem 14. Make sure you understand it, because it's fairly likely that you'll see a Similar problem to 13 and 14, again, not only in real life, but probably in this course in your future. So what we're going to do next is continue with Chapter 16 in this textbook, and that will be our last module, Module 30.